Well, let's bring in our first guest, Tim Rocks, Chief Investment Officer at Evans & Partners. Tim, thanks for your time today. Today was the last trading day for the ASX in July. Looks like it's finished the month up about 6%. Do you think the market's finally bottomed out and is on the way back up again, or is the recession risk too great and could the market plunge in coming months?
Thanks, Edward. Look, I think investors have got this one wrong. They've been very quick to try and look through the end of the rate hike cycle to when central banks will eventually be easing, and that's just way too premature. So I think there's a lot more sort of pain ahead for economies. People are forgetting that the lags of monetary policy are long. It'll take a full year, I think, for the full effects of these rate rises to play through, and there'll be a reasonably large impact on earnings, on employment still to come. So yes, I think it's very premature for investors to jump on this, and there could easily be more pain ahead.
Yeah, as a Chief Investment Officer, where do you look to invest in times like this under this threat of a global economic downturn?
Well, look, you've got to be very, very careful with your money, very cautious. You do take advantage of opportunities that are created. A lot of the time, the good stocks do get sold off with the bad. So you can look for those opportunities to buy good stocks at cheap prices. But generally, it's a time to be cautious, to be sensible, and not to get too carried away with the occasional kind of hypes of improving sentiment like we have at the moment that'll prove to be short-lived, I think.
Yeah, well, this week we had the inflation numbers showing inflation jumped to 6.1% in the year to June, and Treasurer Jim Chalmers expects it to top out at almost 8% by December. How much of a threat is this rising level of inflation to equities?
Look, I think that is absolutely the critical question here, Edward. We really don't know how long this inflation story will last. I think investors have been quick now to think that it'll be a short-term story, but as the Treasurer has highlighted, there are still significant risks, and there still could be many more kind of chapters to play out of this over the next year. We don't know whether there's going to be another energy crisis in Europe, for example, led by Russia and Putin. We don't know whether there are going to be more COVID disruptions, particularly led by things like port disruptions in China. So lots of question marks. We don't know whether the labour market will continue to be strong and deliver wages growth that the central banks will have to snuff out. So many sort of different scenarios can play out here, and hence that's why we need to be cautious.
Buy now, pay later companies have really surged this week. Tim, what's really causing investors to start buying back into them again?
Well, look, I think those buy now, pay later companies have almost become the poster child, if you like, of this sort of greed and fear cycle. They were very overvalued at the start of this year. Their fall has been monumental, more than 90% for most of them. And now when the market wants to sort of sniff a recovery, they've been the first stocks they return to. So many of those stocks have actually sort of doubled or more this week on no real information. And of course, once they start going up, people fear they're missing out, so jump on top of them. So that's just classic sort of behaviour in this sort of type of market. But generally, I think because we think there's sort of more to go in this whole sort of cycle, we'd be very careful on that sector.
The reporting season, well, Rio Tinto reported this week, but the reporting season really starts to kick off next week in August. What are some of the trends you think we might see from some of the big ASX listed companies?
Look, reporting season is definitely critical to the outlook here. What we have noticed is that a lot of the institutional funds are sitting on a lot of cash, have been unwilling to deploy that cash until they see what the reporting season looks like. We would say that from a macro perspective, it's probably going to be okay. For example, JB Hi-Fi reported a little while back and said that conditions are actually still sort of reasonably strong. So the macro will be okay, but what we really don't know is what is going on the cost side. So a lot of companies will face their own problems on costs. How they deal with that and the extent of them is much, much harder to gauge. and that'll be a sort of critical factor that people will look for. So our guess is there will be winners and losers effectively, but and a lot more information to sort of digest than normal.
And look, really quickly, next week, it looks like the Reserve Bank will lift interest rates by 50 basis points. Is the sector that really benefits the most from that the big financials, the big banks?
They benefit in the short term. Certainly they see margin improvement, and you'll see that in the next result. But the really big question for them is what happens to the housing market overall and what happens to asset quality. So yes, good in the short term, but on a one-year view, what really matters is how significant the housing downturn becomes and what that means for asset quality. So again, I think you shouldn't get too caught up in the excitement of the short-term margin improvement, but should be thinking about what the impact is going to be on the economy and asset quality on a kind of a one-year view.
Oh, well, Tim Rocks, Chief Investment Officer at Evans and Partners, thanks for coming on the program today.
Thank you, Edward. Thanks all.